Hello, everybody, to another episode of Awakening Happiness, where we share our discoveries and our stories as we uncover our own and awaken our own happiness. So today, hello, Chris.
Hello.
Today, we're going to talk about other things that are not so good, maybe, or we are in for some interesting transitions. And times are very turbulent nowadays, Chris, aren't they? So we're going to be talking about this kind of turbulence that we're in for in the near future. So Chris has been following lots of specialists into the world of the global economy state. And today we're going to talk about this. Well, he's going to be telling you, and I'm going to be asking him questions so we can share some of his knowledge. Thank you for being open to do this, Chris.
I'm not an expert or any kind of advisor. All I really do is keep abreast of what I see going on and what I hear about, and try and make sense of it as best I can. And I've learned a lot in the last 2 years, being an active follower of various people who have been in the field of finance and economics for for their whole lives. So it's interesting, and it's as well to know and be aware of these things so that you can plan accordingly. So that's really why I do it.
Right. So going into our topic of the global economic sphere or the state of the global economy, we have here a fact that since 2008, more money has been printed than ever before in financial history. And Chris, I've heard you say something about the last 2 years, actually, that the majority of this money was actually printed in the last 2 years. And you know the numbers, I can't remember numbers. You're good with the numbers, so share with us.
Like there was at the end of, I think, 2001, more money was printed in the era of COVID, when the whole world economy was locked down. More money was printed that year. It was like it doubled the amount of money in circulation in 1 year. It's unprecedented, never been done before. And so it all started when they were trying to effectively keep the economy and people alive when they weren't able to work. So all this furlough and all this stuff just basically meant they had to continually print money to keep people going. The government printed money, didn't earn it, they printed it, because how else could anybody get money? Then it's arguably they printed too much, because then what happened was people started investing in the stock market, and they invested in finance, in Bitcoin and cryptocurrencies and assets and equities and stuff. So essentially, through that, what they call quantitative easing, basically everybody pushed the price of assets up. People were moving at this time; they were buying new houses. Because they hadn't got anything else to do really, and they still had money, so they weren't spending it in the conventional ways, going to the theatre, going to the restaurants. So they found themselves a little bit flush, but it was a temporary scenario. But of course, once people have got money in their pocket, they go spend it. So we're in an inflated situation where stock prices are in a bubble, houses are in a bubble. Like lots of things are very high in their value, way beyond what their real true value is, and that's the problem we've got.
And we have a few examples. So tell us about the S&P 500.
Well, the S&P 500's kind of gone up. I don't know what it is, like 500% or something. It's like it's a huge amount. It's gone up from like 1,000 to 5,000. That's a big number. That's massive.
Yeah. So when we talk about this, if people are not sure what this means, S&P 500 is a group of 500 companies, and these are their shares, right?
Yeah, well, it's basically a portfolio of company assets, which is called an index, and it's basically that S&P. You can basically take out equity. Yeah, take it out as an equity. It's an index which you can be part of, and so people can invest in it. A bit like they can invest in Tesla or Netflix. They can invest in this index as well. It's gone up 5 times, 500%, and it's like it's unheard of. Nothing's ever gone up that much that quickly.
And then we have another example of Dow Jones.
Like doubling would be 20,000, tripling would be 30,000. Like
That's more than that.
yeah, it's huge. This is unheard of. Not even the recovery of the Great Depression down in 1928-30 has numbers grown at this speed. It's phenomenal, and consequent. And this isn't real growth. This has been pumped growth by the growth in the money supply. So even though the houses have gone up in value, the shares have gone up in value, yeah, people are still feeling poor. So yeah, inflation has risen by, like inflation has gone from zero, pretty much zero, where it was considered to be too low, to where it is now, which is raging away and out of control. And like these values which are produced by the various governments are really not accurate. You could double these numbers to be more accurate in terms of how people feel how inflation is. And I mean, I know from my own experience, like eggs have gone from 135 to like 269 or something. I mean, it's 100%, not not 10%.
So now the interest rate is 4%.
And they're continuing to do this. So 4% is kind of where it is at the moment, but the expectation is it's going to go to 5%. It may have to go even higher. But it produces. What happens is when the interest rate, if you think about it in the public domain, when the interest rate goes up, people's mortgages go up. So they have less disposable income to go out and do shopping and stuff like that. So the GDP, the economy slows down. But not only that, we're not saving at the moment. So and the problem is that because we're not saving, we're not putting any money away to one side. So that's where we would benefit from increasing interest rates, because we would get like 4% on our savings, but we're not. Actually, we're still only getting 2% on our savings, and interest rates inflation's at 10. So we're net poorer just by keeping our money in the bank. There's no point in saving. But if you raise interest rates, you're basically reducing consumption, and you're preventing people from borrowing money to invest in business. And it also means that if you've got a debt, you're having to repay more money. So basically, it suppresses people spending money. It makes them poorer, basically. So they don't go out and splash out on stuff, and that hopefully means there's a reduced competition for products and services, which means for people to sell the products and services, they have to drop their prices. So that's the plan to stem inflation, because of the government is also trying to restrict the amount of money in the market. So when they borrow money, that creates money in the market when they spend it. But when they buy their debts back, i.e. pay off the people that have the debt, then basically the money disappears, because it's like the negative side and the positive side come together and you end up with nothing. So basically they're tightening the money supply at the same time. So if there's less money around, people can't borrow money, the amount they're paying back on their debts goes up. You basically have less money in the marketplace, and consequently it slows the economy down. And that's the idea behind raising the interest rates, and they're going to continue to raise them during this next year, which means for the man in the street, less disposable income, less discretionary spending, which is basically what they're trying to achieve. Whether it works or not, we'll have to wait and see.
So you shared with me yesterday these three potential future outcomes for countries. So we're talking about governments, we're talking about countries, we're not talking about people, but they will there will certainly be a consequence for the people as well. So let's see what could be the three potential outcomes for countries. I'm going to have my next banner, and you can tell us about these three.
Okay, so yeah, you can watch this video, because the information that I'm going to give you here comes from Simon Dixon's video. It's in the description below. So basically, countries are now faced with one of three choices. And a spoiler alert here, none of these are great. So the first one is they can print more money, right? Because if people lose their jobs, because the companies can't invest, the people buying their products and services go down, then this has a net effect of making companies have less to sell, or basically they have to get rid of people because they can't make profit anymore, so they just lay people off. So the hope by the governments is that in order to control inflation, they basically raise interest rates to the point where companies employ less people, there's less jobs around, there's less money around, people are spending less, and consequently the countries go into a recession. And if they go into a recession, they're hard times, it could be even a depression. In order for people to be able to maintain their lifestyles or do something, at least live, they're going to have more money printing to give those people benefits, help them to survive during this recessionary period. Right? But we all know the reason why we're in this mess is because of printing money. So all that's going to effectively do is increase inflation, and we'll end up in hyperinflation. And if we're in hyperinflation, then there's no good outcome from that. Basically, the currency is basically destroyed, and with it goes everybody's savings in that currency and the banks and everything. So that is a terrible outcome, but it pushes the can down the road a bit more and allows them to do something for a bit longer, for maybe another year and a half, right? They print money. Because the alternative is they raise interest rates until the interest rate, which is number two, is above inflation rate, like get it up to 10 or 11 or 12 or 15%, like it was in 1974. And that would absolutely kill the economy, and we would probably go into a depression, and whoever was responsible for that would probably suffer a crucifixion. It would be, nobody wants to be in history as the person that killed the country. No one would want to do that. So and basically everybody would be incredibly hard up. Like there'd be, you'd be growing your own food for sure. You'd be, it would bring back, if you like, rationing and all those things that we had after the First and Second World War. So that's not a good outcome. The third outcome is CBDC, central banking digital currency. And what this is where basically the government doesn't borrow money to spend it into the economy, but they make it themselves with no borrowing. And basically it's an electronic version of the pound in this country, of the dollar in the US. And basically they'll give you a one-for-one replacement of the new currency for the old currency. And basically what they can do then is effectively get rid of a whole tier, which is the fractional reserve banking sector, and basically replace it with their own central bank, basically, who is now issuing the money. The benefit for them is that they can do this digitally through a digital wallet, and they can basically target the people who are likely to spend the money very, very accurately, because they know everything about you. At this stage, they will know everything about you. They will know what benefits you're on. They'll know how much money goes, because it's all under their control now. And we've experienced AI just recently, and with AI, they can start to very, very easily target things. So if they wanted to stimulate the economy, it's not give the money to the banks produce it, and then people go and buy stocks and shares. They know what people spend the money on. If they give it to people who don't have much money, guess what they're going to go and do? They're going to go and buy food. They're going to go and spend it in a fairly organised manner on things that people really do need. And the other thing is they can give people this money, and they can prevent them from buying. Like, for example, let's say you've got here £1,500 pounds helicopter money. It's free money. You get £1,500 a year, and you go off and you buy an air ticket and you go off on holiday. Right? Now they could say, well, we're not going to let you do that. We're not going to let you buy a holiday ticket, so we're going to ban you from buying those kinds of things. And all you can buy is, like, you can use it down the supermarkets, you can use it down here, you can use it over there. So with the third option, it's more comfortable in terms of financial, but you lose all your freedom.
We plan to kind of finish it and wrap it up at this stage. But this morning, I was reading a reply to a petition to the government, and the title was "Prevent the Introduction of Any Programmable CBDC in the UK." And the government responded, "The government has no plans to program any future UK central bank digital currency or restrict how money is spent. The UK is actively exploring the potential role of CBDCs to understand the wide-ranging opportunities and challenges they could bring. The government and the Bank of England have not yet made a decision on whether to introduce a CBDC in the UK. The government has no plans to program CBDCs or restrict how money is spent. In this context, programmability is when a transaction automatically occurs or only happens when a specified set of conditions are met. Examples of this today include machine-initiated payments that are not reliant on human interaction, such as standing orders and programmable wallets that allow users to set rules to manage their money. However, as payment systems develop and new forms of digital currencies emerge, programmability functionalities could have wider applications. Examples here include an automated payment made by a vehicle or an insurance claim governed by a smart contract, which allows for instant claims payment to be made. Neither the Bank of England nor the government would be able to program CBDCs or restrict how money is spent. If there was end-user demand for programmability features, then any programmability features would be designed by the private sector wallets, and users would have the option to use them if they so wished. Maintaining user safety and privacy as well as choice is a priority as the government and the Bank of England appraise the case for a CBDC in the UK. We recognize concerns about how to ensure the privacy of transactions and users within a CBDC ecosystem, and it is clear that any UK CBDC must have robust systems in place to ensure that any sensitive information is handled appropriately and securely and be underpinned by relevant legal frameworks. Therefore, any potential private sector programmability features will be carefully balanced against the important data and privacy considerations of the CBDC. And this was signed by Her Majesty's Treasury. I've got a link for the reply as well. Maybe I can put that into the description as well. So at this stage, they are claiming that they couldn't be programming these CBDCs, and maybe this, by introducing the CBDCs in the UK, the City of London wants to maintain its position as a, I don't know what they are.
Just as a response to this, nothing ever starts out where it ends up, right? That's the first point. The first point is they want to get the CB. Without CBDC, there is no opportunity to program anything. Having introduced CBDCs, if someone starts to act like a terrorist or someone doesn't pay their bills or whatever, do you not think that they'll say, okay, we're going to stop that bank account, right? They're already doing it manually, the fractional reserve banking, the normal Barclays, NatWest and everything. They're already doing that stuff, but they're manually doing it. Being able to just flick a button and stop the spending or whatever seems to be, it's too tasty to basically not provide the facility for future introduction. And whoever in this planet believes what governments say.
We lost connection for a little time there, so we continue from where we left it. And what I was saying was that the word programmable has different meaning to different people. So what the question was asking was not probably what the government was replying. By the word programmable, the question was referring to what you're talking about, being controlled in this way, the CBDC being used to promote certain types of behavior or stopping certain types of behavior from the users of the CBDC. And what the government was saying was probably different, like, oh, no, we're not going to be programming it. We will probably have living people on the other side, no robots, in that kind of sense of the word programmable. But yeah, so what do you think, Chris? You were saying it's a very tasty thing to have this ability to click buttons.
But you have to look at why a government would choose to implement CBDCs, right? They choose to implement them because it's a no cost way of introducing more money into the economy. If they're going to do this, then they need to take advantage of the fact that CBDCs enable them to target certain people more effectively to send money to and inject money into the economy is directly where it's needed, not in the current form, which means they have very little control over who gets the money in the end and what happens to it. So, yeah, the main reason for implementing CBDCs is to remove cash and move to a digital money, right? And cash means they can't manage it, control it, and see where it's gone, right? So cash is a thing to be moved to one side. And the other thing is to be able to target people more effectively when they need to boost the economy. Now, if they're not going to take advantage of those things, it's absolutely pointless implementing a CBDC. Now, if they're going to be able to target wallets, specific wallets, are you telling me there's no programs behind that? They just aimlessly go, oh, that one, that one, that one, that one, or do they have a program which works out which ones are most likely to do the most good? It's like it's obvious. Now, the government is just wanting to introduce CBDCs because it offers the potential for total control over people's money. And don't tell me that they're never going to use them. What did they do with the terrorist legislation, the terrorist activity legislation? What did they do in Canada when people started supporting these truckers and stuff with money from PayPal, and they shut the bank accounts down. Right, that was all they could do. But with the CBDC, they could be very, very more clever than that. Yeah. So you know, like this is just a Fed talking, the Federal Reserve in America. Oh no, inflation's not out of control. We've relabeled how we calculate it, and it's down at like 5.1 or something. Well, no, we know it's over 10 there. They've just relabeled it, made it difficult to calculate, and come up with a number because they want it to be low. No, we're not in a recession. We're not in a recession at all, because the calculation for recession now is not just 2 months where GDP is negative, but we've also whacked in something about unemployment levels and then manipulated how those are calculated. So they're not in recession. We all know damn well they're in recession, and we all know we're in recession. And it's manipulation of the highest order. And this is no different. This is just another manipulation technique to pacify people, to allow it to happen, and then they come in with the tweezers and the surgery a bit later on, when we've all kind of forgotten. We've all kind of forgotten what was going on in the first place.
So the question is then how to navigate these changes, and what are people's choices? Well, obviously we shouldn't be very trustful of these statements to begin with.
I mean, the thing is that in order to retain any level of flexibility, you've got to try and cater for any of these situations happening. If there is hyperinflation, it means the money's worthless. So what isn't worthless? Commodities. And by that, it could be anything. It could be oil, it could be wheat, it could be... but for human beings like you and I, the most accessible thing that's been recognised as money for 6,000 years is gold and silver. And like, if you can have some of that in your portfolio, at least it's not going to be degraded by inflation. It might go, because what's the value of gold? It's like, it's not $1,000 anymore. If dollars are like 10 a penny, it's going to be $100,000. But no one wants any dollars. So what's the point in valuing gold in dollars? You just, what can I buy with it? What is someone prepared to give me in exchange for gold or silver? It's back at that level, I'm afraid. So there is a potential that we need to prepare for that. And my recommendation, I've done it. Is get a little bit of silver, get a little bit of gold. Like at least hedge your bets, give yourself a chance that if it does result to that, you've got something that's not gone down in value, where your house might go through the floor, your job might disappear. Have something in those areas. The other area, of course, which is these things are outside of the system, unless they come around and basically bludgeon you over the head and take your gold and silver off you. It's like you're going to have it, right? The other option, and also if you put it into a bank vault, by the way, the bank might be closed next week. So although there's risk, you don't want any counterparty risk, i.e. someone in between you and your money. You don't want anybody that can say, no, the door is shut, you can't come in. So the next thing is something like Bitcoin. There's a limited number of it. It's much like gold, but it's online. It's not a physical entity, but there's a lot of people that have invested in Bitcoin and cryptocurrency, and it's making its name for itself. And although there's lots of trouble in the crypto space at the moment, all this is going to lead to proper legislation and make it more legitimate for people to be able to invest money in it. And once the money markets, and people say, where can we put our money? Where can we put our money? It's safe. The gold and silver, yeah, but I can't store this gold and silver. Oh, hang on a minute. Bitcoin represents a good opportunity because it's external from the government, not controlled by anybody, same as gold and silver, and you can keep it on one of these.
Yeah. Just a disclaimer here, we are not financial advisors. You check do your own studying into this, but we have a few links in the description to see what the specialists are saying.
You can't buy gold and silver off me, and you can't buy any Bitcoin off me. So I'm not trying to sell anything here, by the way. Just what I'm saying is, it pays to be to basically have some money in the bank, because you might need to, obviously you need to pay your rent or you pay for food and stuff. You need money in the current system until the current system isn't there, and then that might happen. It might not happen, but do your research on that. But also having some money in other places where it's not going to just disappear, and you can't have it. It's yours. You've got it. That's the key. And how which one you invest
yeah.
in, just just do some analysis work and work it out. But
Say if I have a financial advisor that I've been using for the last, I don't know, 40 years since I was an adult to advise me on what to do with my money. But in these troublesome, changing times where things are really going to be into a fluctuation and the old ways might not quite be what the new ways are going to be, and if a financial advisor was advising you from before, you need to ask yourself, is this person aware of the changes? Are they going to be actually giving me a piece of advice that I'm going to trust because they know what's coming? Well, can you elaborate on this, Chris?
yeah, absolutely. I mean, like from my point of view, my first question would be, what do you know about cryptocurrency? And I would listen to the response, because the response might be, oh, they're very, very risky. I wouldn't even bother looking at it. What you'd be better off doing is looking at your pension portfolio, and let's look and see how we can better arrange that so that it works better for you. And the reason that the normal pension advisor or financial advisor might do this is clear. They get paid if you buy their products and services. That's just the way it works. The products and services they know about are the ones they've been trained on, which are the products and services offered by their company. All right, so it's about their company and retaining you as a client. And I'm not suggesting you take all your money out and do something else with it. I'm just saying you have to know from which direction the advisor is coming from. If they have no knowledge of cryptocurrency, then in my view, they have no capability to advise you, because crypto in blockchain is something that's coming in the future. If they're a financial advisor, they should be aware of all products and services out there and be able to speak competently about all of them if they claim to be a financial advisor. And I don't think they are fully competent, because all of the banks, all of the insurance companies and pension funds wanting to at the moment play with what they know, and they're not really equipped, and even speaking about the potential financial catastrophe that's on the horizon. They don't want to worry you, and they don't want your money leaving, because that even makes it worse for them. So they're just basically going to try and hold on to you. And my view is there has been no more exciting time in the financial world than the one we're entering into now. But it does put an onus on us as individuals to basically learn more about this financial marketplace. And if we leave it to the professionals, we're in danger of losing everything. We are in danger of being hammered bad time. I don't mind if they go. I don't mind if they go bust, as long as they don't go bust with my money. The key with these investments is to basically not invest more than you can survive without. Like basically, if you put your money into gold, silver, or Bitcoin, you need to basically be able to put it there and leave it there. You can't go in there and speculate unnecessarily. All of those things are what we call a store of wealth. So basically, it's about maintaining your wealth and not losing it, keeping it, not subject to bankruptcy and stuff like this. So if you can keep it, and you don't need it tomorrow, keep the other money you need tomorrow in the banking system and everything else. This is money you're going to put away and leave for 2 to 10 years. It's money you're just going to leave there. See what happens. It might be that silver comes through a massive boom over the next 3 years and you double your money. That's lucky, right? That's lucky. That's not the purpose of it. The purpose of it is to not lose anything.
To preserve it, a store of value. Okay. Well, thank you, Chris. I think we've covered kind of in broad terms the main aspects of what's happening these days and maybe in the future. There will be 3 links in the description, videos from real people who are knowledgeable into this area of finance, and highly recommend that you watch those.
No.
That's it. Well, thank you very much for sharing your knowledge. You have a lot more, I know. Maybe we'll do another one on cryptocurrencies to spread a bit more of a clarity and explain what it is and what it isn't, because there's quite a lot of confusion, I think, in this area. So, see you on another episode tomorrow. We're going to be streaming it live tomorrow. Bye.